Hello everyone, this is Professor Chandana Goswami and today I will discuss about securitization of debt. Suppose there is a hypothetical bank which is giving out loans and in return it is expecting repayments. And we know that only when the bank will get the repayments in the form of interest and principal, then it can give out fresh loans. If the repayments do not come in time, then the bank is in trouble. It is going to face liquidity crisis, and in order to issue fresh loans, it will again have to borrow from the Reserve Bank of India. So what can the bank do in such a situation? It has this option of securitization. The existing loans that are there and which are backed by mortgage, these loans can be securitized, and when it is done, the bank will get cash in hand against which fresh loans can be offered all over again. Suppose this bank has a portfolio of loans, and please remember all these loans have to be given against securities. For example, we know that when we take a home loan, we have to mortgage the property papers. If it is a vehicle loan, we hypothecate the vehicle to the bank, and same is for commercial loans. So this combination of loans, this portfolio is worth 80 crores, alright. And after a period of time, that is after the maturity period, and depending on the interest, let's assume that the bank will get 120 crores coming in. And using this 120 crores, it can again issue fresh loans. But it will take time for 120 crores to come in. So what will the bank do till then? It can do the process of securitization. You can see in step 1, the bank is issuing loans to the borrowers. Alright, and then all the property papers and all that are mortgaged with the bank. So the bank has this security with it. Now this portfolio of loan is transferred to a special purpose vehicle, which is a financial institution, which means that the loans are bought by the SPV and cash is given to the bank. So in our example, the loan portfolio of 80 crores, which would have become 120 crores, say 5 years or 10 years from now, is being sold to the SPV. And the SPV is giving the bank only 110 crores. But the bank is not losing out. Why is it not losing out? It is because it is getting the 110 crores immediately. For getting 120 crores, it would have to wait for many more years, a couple of years. Alright. So now this bank has cash with it and it can give out fresh loans. Now what happens to the SPV? This SPV will convert it into small securities, which are referred to as PTC out here. I will explain what it is in the following slides. So these PTCs are sold to retail investors like you and me. It is, for us, it is like buying a debenture because a fixed rate of return is promised to us. Alright. And the special purpose vehicle is going to pay us interest and redeem the original value at the end of a term. Where is the SPV getting the money for this? It is getting it from the interest that the original borrower is paying to the bank, and the bank is now moving it to the SPV because all the loans have been sold to the SPV. Alright. So now this is a win-win situation for the bank as well as the SPV. The process of securitization has the following steps: identification, transfer, issue, credit rating and redemption. Identification. The originator, that is the bank, identifies a homogeneous pool of assets. The pool of assets, the portfolio of loans that you are going to sell to the SPV must be homogeneous. And homogeneity is in terms of maturity period. Like, for how many years this loan is. They must be approximately near about in the same range. Second is, what is the interest rate? Again, interest rates also have to be near about in the same range. Third is frequency of payment. Is the interest payment or the interest and principal repayment from the borrower coming on a monthly basis or a quarterly basis or a half-yearly basis or maybe even an annual basis? And the last point is marketability. Can these loans be sold? Once it is identified, then this pool of assets has to be transferred. Alright, so we are saying the pool of assets is to be handed over to a willing institution known as a special purpose vehicle. There is full transfer of assets for a valuable consideration. So in our example, we are saying that 110 crores was given for the portfolio of loans. What does the SPV do now? It is going to issue PTCs. So the SPV converts the entire package into small individual securities. So this 110 crores is being now broken down into small units called PTC, and they are sold to retail investors. It can be a pay-through certificate or it can be a pass-through certificate. There is a small difference out there. In a pass-through certificate, the interest earned on the receivable is directly passed on to the holders, whereas in a pay-through certificate, the interest received from the receivables is not passed to the holder of the unit. Instead, the SPV issues new securities to them. In either case, this 110 crore is now broken down into small units called the PTC and sold to retail investors. So if you and I, we buy PTC, it is almost equivalent like buying a debenture, because there is a term period. Alright, then you have a principal amount which is going to be redeemed at the end of a term, and interest which is going to come in every year or maybe in one shot at the end of the life of the PTC. So again, if you can look at this diagram, you can understand that the PTC interest and principal repayment is going to happen from the interest that is received from the original borrowers by the bank, which is then passed on to the SPV, and SPV uses this amount of money to pay off the PTC interest and also redemption. Once the PTCs are created, you must have a credit rating for it, as you have for a debenture. These have to be rated by independent credit rating agencies in terms of timely payment of principal and timely payment of interest, exactly like a debenture. And this is done to ensure liquidity in the secondary market. At the end of the term of the PTC, it has to be redeemed. So we know that the bank is collecting all repayments from the original borrowers, or if the SPV wishes, it can appoint a special servicing agent also to do the job. Alright, and the redemption and interest is paid from these collections. So that was about the process of securitization. Next comes the question, what are securitizable assets? So these are some of these assets which can be securitized. Term loans of financially sound companies or receivables from government departments, credit card receivables, hire purchase loans, lease finance, mortgage loans. You must have heard of the word factoring. So let me explain the small difference between factoring and securitization. Factoring services are used when you have money blocked in your trade receivables. So you sell off your trade receivables to the factoring institution, who then gives you a lump sum amount of money immediately. All right. And trade receivables is short term in nature. And once you have sold off the trade receivables to the factor, it is the job of the factor to do the collection work. While in securitization, we are thinking in terms of loans, lease, hire purchase and all that, which is long term in nature. And the collection in this case is done by the originator, that is a bank, or by an agent. I mentioned that a PTC is almost like a debenture, but again there is a small difference. When a company issues a debenture, it keeps in mind that the interest payment that is going to be done is based on the cash flow of the company, and debenture is a direct debt instrument. In case of a PTC, the payment burden is on the SPV. Should the original borrower be unable to pay the interest and principal amount to the bank, and in turn the bank is not able to pass it on to the SPV, you and I as PTC holders are not interested in that. We want the repayment coming from the SPV because we bought the PTC from them. Hence, we are saying that the payment burden is on the SPV. And this instrument PTC is a derivative of debt. So these are some of the benefits of securitization. The liquidity position of the originator improves. That we can see because the bank has now got cash in hand by selling off the loan portfolio to the SPV. Recycling of funds. Yes, the funds have come back immediately. Alright, 80 crores converted into 110 crores immediately and was given out again for fresh issue of loans. Improves capital adequacy ratio. Your capital adequacy ratio is defined as bank's capital divided by risk-weighted assets. In case of a bank, the loans are assets. And in this case, through securitization, you had removed a large chunk of your loans and you sold them to the SPV. So therefore, your denominator decreases. But then this improvement in capital adequacy ratio is not really a long-term improvement. Why? Because you're using the money that came in to issue fresh loans. And when you issue fresh loans, your risk-weighted assets in the denominator will again go up. Credit risk can be diversified. Yes, whatever credit risk was associated with those loans, the bank diversified it by selling it off to the SPV. And because the liquidity position improves and the credit risk was diversified, capital adequacy ratio also improved to some extent. Therefore, the bank is able to offer greater protection to its investors. Why should commercial banks opt for securitization? Number one, it is a low cost source of fund. In this securitization, it is the bank's money only which has come back to the bank along with some amount of extra interest. If securitization was not done, the bank would have to go to the RBI and borrow more. So in this case, through securitization, the cost of fund is kept low. Capital adequacy norms can be improved. I have explained that in the previous slide. Creation of more credit. Yes, when the cash comes into the bank, it can offer more credit. Profitability can be improved. When you have low cost source of fund, definitely profitability will improve. NPA can be removed by this technique because you have shifted your loan portfolio and you sold it off to the SPV. So the NPA associated with that is no longer your problem. However, let me also tell you that when these assets were selected to be sold to the SPV, these assets were selected with utmost care. Alright, where the buyer checked to see that the probability of default is going to be very, very low in this case. So I'm not really very sure about how far the NPA can be removed by this technique. These are some of the conditions for successful securitization. Select assets on the basis of least loss. Like I mentioned, that the SPV will select the assets where the probability of default is very, very low. Second, the PTC that is created must have unquestionable credit rating. Otherwise, you will not get buyers for it. Number three, the SPV should be separate from the bank. It cannot be a subsidiary of the bank. Then PTCs should be listed on the stock exchange. That is how you can offer liquidity to the buyers. And loan agreements must be standardized and carry a right to assign debt to a third party. This is for the bank. All banks must have a standardized loan agreement where it is written that this loan can be transferred to a third party. Then it is possible for securitization. Thank you very much.